That's what you saw pop up there. Thanks, Terry. Welcome everyone again. And yeah, other than not recording last time, I was also in the middle of changing planes, so I'm not doing that today, thankfully. So I'll probably be a little bit more methodical and hopefully a little clearer. We are going to take a view of capital funding and really focus in on debt and assessments in terms of capital funding and whether they are or are not acceptable or best practices or something else. So the level setting or the table setting is to all get us all on the same page in terms of really what drives the financial outcome in clubs. And it's so critical. These things that we've learned in the last couple of years, I just feel are so critical. They're so central to making clubs healthy over time in a sustainable manner. That we have to zero in on it, and if we can make headway in these concepts, I think it can have a profound impact on the club industry, on your club, and frankly on the dialogue that occurs in the boardroom and the management room. So I'm going to go through the concepts around driving the financial outcome in clubs, how important capital income is in the hierarchy of capital income. Some capital income is better than other. Obviously, why we need capital, and then the whole concept of why assessments, what are the pros and cons, or why debt, what's good debt or bad debt, or right debt or wrong debt, because we believe there are differences, and sometimes debt is applicable and sometimes maybe not so much. And then just a kind of a summary on what a best practice approach is to capital planning. The thing that's so important from a contextual standpoint that has to be front and center in any discussion about anything going on in clubs from our view is what's going on in society, because it's having a profound impact on clubs, and we need to understand it. Clubs are in a dynamic market. Demographics of the United States are changing drastically and quickly. And the baby boomer generation to this point, let's say if you look back at the last 20 plus years, the baby boomer generation has driven the evolution of clubs, the value proposition in clubs, and the membership in clubs. There's 76 million baby boomers. Baby boomers are basically 55 to 75 years old. And the folks who are now at the tail end of their club career, especially if we're in the Northeast or the Midwest, the central part of the country when people tend to retire and obviously migrate south, the clubs in those areas can see this in a seriously magnified way. When a member tends to exit a club, it tends to be a baby boomer because they've retired, they're moving, they change their lifestyle. I have a buddy, I'm 60, my buddy's 64. I just saw him the other day. He's a member of my club. He has to take the year off because he just had his shoulder replaced. So those are the kinds of things that are affecting baby boomers now. And when those seats in clubs are vacated, they're filled by people. We just did a research recently of people who joined private clubs in the last 3 years. The average age was 42. And so they're replaced by people who are in their mid-30s to, let's say, 50. That's the typical joining age of a private club. 42, based on our data, is right smack in the middle of that. That's Generation X. The problem we have, and one of the reasons clubs are having capital issues, is because the Generation X group, who's 35 to 55, there's only 55 million. The difference between 76 million and 55 is 30%. So there's 30% fewer prospective members able to fill the seat of an exiting baby boomer. And that's what's putting stress on the industry. That's contextual. That demographic shift, we believe, is the reason that many clubs have lowered or eliminated their initiation fee, which is obviously constricting a main source of capital if you look back over the last 20 years. And obviously it means that most clubs, depending on, we don't have perfect data on this, and you could look around the industry, but I think generally speaking, the industry would embrace the concept that 90% of the clubs in the country could use more members. Maybe some of them can only use a few more, but many of them could use a heck of a lot more. All those are part and parcel of this demographic shift. So what we're trying to investigate and understand is what drives sustainable success in this current market environment. And we really lean on a three-legged stool. We have a financial model that we've developed, which we've introduced on this webinar a number of times over the years. And that financial model allows us to map data from each club. We get about 1,000 clubs worth of data a year from all across the country into a homogeneous format, apples to apples format in the database, so that we can compare clubs in a very consistent manner, both over time and to each other. And our financial model has led to a bunch of insight. We've learned a lot, and that learning has manifested in what we call the key performance indicators. We believe these are literally the KPIs, the vital signs in terms of financial and operating outcomes. Excuse me, I'm getting over a cold. In private clubs. I'll address that as well during the webinar, but the most important of those KPIs are the ones that relate to capital. And then the whole concept is that in the boardroom and in the management room, we embrace the facts to help us make better governance and management decisions. There's three things that we think the data shows very clearly. First, that sustainable success over time in a private club is a result of consistent and continuous investment in the club, which by definition means change, because if you're consistently and continuously investing, then the value proposition is consistently and continuously evolving. And that's exactly what we want, such that the club can remain relevant and in sync with the changing demographics that are occurring, which we just saw in the previous slide. We know from our data shows very clearly that relevance in terms of appeal to a broader array of prospective members, in terms of more demand for a given club, in terms of higher initiation fees as a result of more demand, all of that ties to diversity of amenities. The broader the services and amenities a club offers, the more relevant it is to a broader prospective base of members. And the more relevant it is, the higher the initiation fee is going to be. The clubs that are struggling the most for members and have the lowest initiation fees, and thus the least capital income, are the clubs that are the most golf-centric. I'm an avid golfer, so this is coming from an avid golfer. I hate to say it, but it is what it is, and it's what the data shows us. And then finally, this is the second time, as Terry said, we've done this webinar in 2 weeks. And the first time we had more people on the webinar than we've ever had on any one webinar. So something resonated. And I believe it's the resonance is the concepts of capital assessments and debt. I think that clubs have struggled with those things over the years. But there's a resonance that's important. If I were to underline the resonance, it's this third point, which is, I know there's board members on this call as well as management and staff, but I'm speaking to the board now, or the committee members on the call or the webinar. When we are concerned about financial outcome in our club, what's happening in the industry, and what we believe we can show, and I will show with data today, is we get wrapped around the axle in terms of the operating ledger, and we do not focus enough attention consistently on capital, the generation of capital. The data shows very clearly that successful financial outcomes in clubs are based on the ability to generate capital over time. They're not based on the ability to manage costs or manage efficiency. That's not what drives a club, and we'll get into that in some detail. This is the way we look at a club in terms of key success factors. It's a systems view of clubs. we started the company investigating, and it's still the core of our business, understanding finances in private clubs, financial outcomes, financial position, financial sustainability. But that whole financial picture is really an outcome. It's a result of something. And we know finance and income statements and balance sheets in business are really the scorecard or the scoreboard for the things that we do in terms of running the business. In a club, the most important driver of the financial outcome is the member experience and the membership core. A club's ability to retain, attract, satisfy, make emotionally and financially attached to the club, the better we can do at that, the healthier the club will be financially. Every club has a footprint. If you look at your own clubs, there's clubs on this webinar, I'm sure, that are 100 plus years old, and there's clubs that are 20 plus years old, new clubs. But when you look at your club, it has a physical footprint. It has a clubhouse of a certain size. It has a certain number of holes of golf, or if it's a yacht club, it has a certain number of moorings or docks. It has a certain number of acres, has a certain size parking lot, etc. The footprint actually has, independent of anything. I was at a club earlier this week, and I'll mention it in a minute, but the footprint has needs in terms of funding, operating funding needs and capital funding needs. And those needs are directly related to the size, scope, and current status in terms of the maintenance, past maintenance of the footprint. It's independent of whether the members want or don't want to contribute money, or whether the members are cheap or not cheap. I was in a club earlier this week where it's kind of in the culture. It's kind of like we don't really invest in the club. And these key capital metrics we're going to look at didn't look so good for that club. And I was trying to express the view that the data shows clearly that there's a need, and the need hasn't been met. So you only have one choice, really. Either you're going to meet the need, or it's going to continue going in the wrong direction. And so we have to embrace that concept. If on the board of our club, our footprint has capital needs of X, let's say, and operating needs of X, if we have 600 members and we decided in the next board meeting that we doubled the membership and we could bring in 600 more members, then the cost for any one member would be 0.5X. On the other hand, if we decided to shrink it and make it only 300 members, then we would have a cost per member of 2X. So the footprint's needs for funding are independent of the culture and everything else. They're there, they're present. And then there's only two variables that drive the funding, both on operating and capital. How many people belong and how much they pay. So we have to make sure that we optimize both of those variables in terms of funding the footprint. And this member experience isn't an island either. It rests on three pillars the way we see it. One is the programming. That's the services and amenities that we deliver to members. That manifests itself financially on the income statement. Two is the physical plant, which is what we're zeroing in on today. That is the result of characterized by the capital needs and the capital resources that are available. That manifests itself on the balance sheet, and we'll show that in a minute. And then the staff and the staff's engagement and how they add to, hopefully, the member experience. Those three pillars form the value proposition that has the impact and outcome that relates to the membership experience and the ability to attract and retain members. If we have a club that's worn and dilapidated, and there are many, it's not going to be a club that has a very compelling offering for prospective members, and they're going to have a low initiation fee because it hasn't been properly, the physical plan hasn't been properly maintained. The board and the staff, I'm using the board here because ultimately they're the fiduciaries. The board and the governance and the culture in the boardroom supports this entire thing, this entire structure. And what we have to do is we have to make sure we're viewing things through the right lens in that room. Every club has a culture and has members that fall somewhere on the spectrum. What we've observed is in some clubs, most of the members think of themselves as customers. Member-owned clubs, member-owned not-for-profit clubs. The culture is don't come after money from me. I don't want to pay a dime more. I don't care what the club needs. That's not thinking like an owner. The healthiest clubs in this country are the clubs that have a core of the membership who think like owners, and they realize we own the club, and if the club has capital needs, there's only one way to fulfill those needs. It's through members and incoming members writing checks that get contributed to capital. There is no other way. You could sell assets. We'll talk about that in a minute, but that's not a long-term sustainable approach. So when it comes to capital needs, the members have to fulfill those needs. This slide shows a concept that we've learned in the last 2 years, and I tell you, if I had to pick one slide that we think could have a profound impact on the industry, it's this. What you see here is on the blue line, we show there's 1,000 clubs on both of these lines. On the blue line, we show the operating result. So we use percentile rankings as opposed to averages so that we can illuminate variation. Averages blur variation. So the median, half of the clubs fall below, half are above. The 25th percentile, a quarter below, 3/4 above, and the 75th percentile, a quarter above, 3/4 below. If you look at the median, what you see is 1%. So that says that club had an operating result of 1% of its operating revenue. If we were to characterize that using words instead of numbers, we would say that's a break-even outcome. Clubs set the operating ledger to break even, excluding depreciation. Clubs don't count depreciation as an operating expense, and they set their dues based on the number of members to cover the operating expenses so that there's essentially a break-even outcome at the end of the year. At club benchmarking, we kind of look at it and say -4% to +4% is essentially hovering around break-even. That captures just about 70% of the clubs in this chart on the blue line. The clubs to the far left have significant operating deficits. The clubs to the far right, about 10% of the clubs in the country do consider a depreciation operating expense. So they generate a cash surplus off the operating ledger equal to the depreciation expense. 90% of clubs don't do that. We'll leave that to the side for now. So the point is that the operating ledger, by definition, if it's set to break even, and it does indeed break even in that minus to +4% window, as demonstrated by the data, then by definition, it is not the financial driver of the club. So if you take the club at the median, the 1% operating outcome, that gold line depicts the capital income as a percentage of operating revenue. So the club that had a 1% operating margin had capital income equal to 12% of its operating revenue. That's the free cash, or the money, that drives a club forward financially. We consume the operating ledger year in and year out, enjoying the club. The cash that we have to reinvest in the club and drive it forward comes from capital income. That one concept is critical to understand, because when boards and finance committees, when we're sitting and members in the grill room, when we're, scrutinizing the finances of our clubs, we get wrapped around the axle on the operating ledger. We pay the superintendent too much. We don't make enough in food and beverage. We don't spend enough maintaining the golf club. These are all operating ledger things. It's not a financial driver. We think that's where financial success lies. It does not. Financial success, as demonstrated and proved by this slide, lies with the ability to generate capital income. If you look to the left side, the 25th percentile, a quarter of the clubs have a capital income equal to 6% or less of their operating revenue. We think at a minimum it needs to be 15%. So that's the quarter of the industry that's in severe financial distress as we see it, because they aren't able to generate capital income. And there's another way of looking at this, and this is a critical view of the situation. We've investigated now for about 2 years what's happening to the net worth, which is the book value. If you look at your balance sheet at your club, it'll say members' equity, unrestricted net assets, stockholders' equity, whatever the phrase is to characterize the book value, the ultimate equity in the club. We just refer to that as net worth. And there's a concept that evolves from the previous that's really important. If clubs set their operating ledger to break even, excluding depreciation, and what does any organization or individual want net worth to do over time? Clearly, we want it to increase. So if it's in a club and net worth must increase, the only way we can increase net worth in our clubs is if we generate enough capital, earnings before depreciation, which is driven by capital, as we just saw, to overcome the depreciation expense. If we can, the net worth will go up. If we can't, the net worth will go down. This chart shows over 600 clubs, most of them going back to 2006. It shows the net worth, the book value year by year over that period of time. 30% of the 600 clubs are worth less today on paper than they were in 2006. 30%. That's not even considering inflation. That's in absolute dollars. If we consider inflation, which we must, which has averaged just about 2% a year since 2006, to be precise, it's 1.8, but we use the rate of inflation for construction because we're concerned about capital in this case and capital assets. If we consider inflation, half of the 600 clubs are worth less in real dollar terms today than they were in 2006. So half of the clubs are actually going backwards in terms of their value. That's not good. And we're going to look at how that really reflects what goes on in capital. So this is a model of the balance sheet that we use in our financial insight model. By the way, I'm going to take a break because, Terry, we are a little more in sync. I want to make sure that if there's any questions at this point, I can take them because I'd like to take them in real time.
I have one question that was submitted that's not exactly at this point yet, but let me read it to you so you can keep it in mind. What amount of borrowing is appropriate for aspirational debt? Are there guidelines that can be discussed? The first webinar focused on not using debt to fund past repairs and maintenance, but Ray didn't talk very much about funding plans for master plans and aspirational debt.
Excellent. So yeah, we'll definitely touch that. And when we get to the debt section, please remind me. And if you have any questions, I didn't say that at the beginning of the webinar, I'll take them in real time. I think it keeps people engaged. So you can shoot them off and Terry will stop me and we'll answer them. When you look at the balance sheet, what we do is we use the average club's balance sheet. We've got over 600 clubs' balance sheets that this data is formed on. When you look at the average club's balance sheet, this is the way it looks. It's 70% equity, 30% liabilities. Liabilities in clubs, for the most part, it's really just bank debt. There are some other items, short-term liabilities like accounts payable, et cetera, but they're really minuscule or minimal in terms of the overall asset base. 30% of a club's balance sheet is liabilities, and most of that relates to bank debt in the average club. 70% equity. Following on the thread of logic that we've established, if clubs don't generate a financial outcome off the operating ledger, then the equity, which is essentially the net worth of the club, it's also what the members have, it's equivalent to what the members have contributed over its entire history in capital. Because again, that operating ledger has been break even. So that equity, the members' equity, is ultimately the simplest way of viewing the equation of the growth of equity is capital income minus depreciation expense. And if that's positive, the equity goes up in that year. If it's negative, it goes down. When you look at the other side of the balance sheet, assets, this is how it all ties together and it stays so simple and clear. The average club, 80% of the assets end up on one line item, and that line item is the net book value of property, plant, and equipment. So it's the total value of all of your physical assets after all of the accumulated depreciation to date. 80% of what a club owns. By definition, it's really important. When we think back to the net worth data that I just shared, if half of the clubs are worth less today on paper than they were in 2006, the equity is less. What's happening to the asset side of the balance sheet? What's happening to the property, plant, and equipment? By definition, we're consuming it. We're not replacing it at the rate it's depreciating. So we're literally consuming our clubs. And the reason that's happening is because we're not generating an adequate amount of capital income. And I'll just go one step further. I believe I've come to a conclusion, excuse me, based on the data and my travel to over 350 different club boardrooms over the last 10 years. I've been in front of boards of more than 350 clubs. And the conclusion I've come to is the reason this is happening is because we're so focused on the operating ledger, we forget about capital. I actually believe it's less to do with money, and it's more to do with focus. And that's our passion. Our passion is trying to get everyone to shift their focus. So if the net worth isn't growing suitably, then the PP&E is going to stop being worn and outdated. If it is growing appropriately, then the property, plant, and equipment will be fresh, it'll be up to date, and it'll be relevant. Let's take two examples of clubs. One club that was built 50 years ago, and it cost $3 million to build. If you look at its balance sheet, the gross property, plant, and equipment's $3 million. Let's say the investors have the members have never reinvested a dime in the club. The accumulated depreciation will be $3 million, and that makes the net PP&E of that club zero. If you did the ratio net to gross, it's 0%. Take a club that's brand new. It opened its doors yesterday. It's obviously more expensive to build today than 50 years ago. Let's say it cost $30 million to build. It doesn't have any depreciation yet because it just opened. So the accumulated depreciation is 0. The net PP&E is 30. In that club, the net to gross ratio is 100%. If you walked in that club, it would smell new, it would look new, and it is new. It's brand new. If you walk into the club on the left, it doesn't smell so good, it looks like crap, and it is all completely worn and depleted. Every club is going to have a ratio, a net to gross PP&E ratio, which literally takes all of 1 minute to calculate on using your audited financial statements. Every club is going to have a ratio between 0 and 100%. There's 600 clubs on this chart. It goes from, these are real clubs, by the way. The one that had the 0% ratio, I just made up. These clubs are real. These clubs exist today. There's a club in our database that has a net to gross PP&E ratio of 8%. There's clubs that have one of 15%, 20%. You can see what's going on the left side. The median of the industry is 48%. The highest is 82%. So half of the clubs have a net to gross PP&E ratio less than 48%. When you think in terms of what that median means, what the median means is the average club has an asset base that's about halfway through, in aggregate, halfway through its depreciated life. There's a certain club that we've done some work with that has a net to gross ratio of 35%. I'm just using it as an example of what happens. So they have a net to gross ratio of 35%. Their net worth has been declining at an average annual, compounded annual growth rate since 2006 of 7%. And they have a debt to equity ratio of 420%. So this is a club that's really all upside down. The net worth declining, as such it can't keep reinvesting in its obligatory capital. As such its facilities and assets are becoming more worn and depleted. They're becoming more worn and depleted the last debt they took on, the club put the money into the golf course. Golf isn't the driver of relevance today, so they haven't been able to replace or pay that debt back with capital that was accruing as a result of members joining, because people just yawned. Yeah, you redid your golf course. Okay. So it's all upside down. And by the way, all these metrics, everyone on this phone or this webinar, everyone can calculate these for their own club in minutes. And by the way, when I went to this club, we'll call XYZ, I can tell you the culture of the club, the board, the finance committee, the membership, everyone was focused on one thing. Why aren't we making money in F&B? That was what they want. They wanted to profit in F&B while the club is literally dying on the vine. Another angle on this. So if the capital that's available has to be greater than depreciation, this chart on the blue line shows the capital available and the gold line shows the depreciation. You can't just generate enough capital to meet depreciation. That won't allow you to replace the assets. Depreciation is a backward-looking expense. Replacing the asset is in today's dollars. So you actually have to generate more capital than depreciation, and that's where I get a little concerned when we use the term funding depreciation. We think funding depreciation is enough. It's not enough. I put a line on this chart at about the 70th percentile, and it's at that point where the gap between the earnings before depreciation, which is driven by capital income, is 3 percentage points greater than the depreciation expense itself. We think that's the minimum threshold for clubs to be able to consistently replace themselves in a holistic manner and keep things updated and fresh. That's only 30% of the clubs. 70% of clubs are not generating enough capital. So we have over 100 clubs on this webinar today. Over 70% or 70% of the folks on this call are not generating enough capital. It's a critical issue. The ones to the far right, where you see the gap getting larger, meaning they have more capital than just depreciation in current dollar cost, those are the clubs that have remained relevant over time. Those are the clubs that have consistently invested over the last 10 years. Those are the clubs that have the higher net worth results growth in net worth results over the last 10 years. Those are the clubs with the highest initiation fees. It's a virtuous circle. Those are the clubs that can not only replace what they have to, maintain and repair, they can actually invest in expanding the asset base to add more services and amenities to make it more relevant, to make it more compelling, to offer a broader array of services and amenities, to attract more members, to have higher initiation fees. So 30% have enough to replace what they have, but about half of that bucket is generating even enough to expand the asset base. Those are the healthy clubs.
Ray, we have two questions.
Yes.
The first question is, in looking at the balance sheet, should you look at depreciated cost or current full market value? Suppose full market value can only be realized by selling the property.
Yeah, well, just to be clear, that's a very good question, and I get it often. I want to make something clear, please. When we talk about the book value of a club, and what this whole analysis and thought process is regarding a club as a going concern. Yeah, a club might be able to have a market value that's much greater than its book value. By definition, most clubs do, because they probably have real estate that's worth more. However, the only time that's going to manifest itself if the members decided to sell the club and close the club. Everything we're doing is looking at the club in terms of it as a going concern. One place that market value will have an effect potentially is the ability to take on debt using the assessed value as collateral. So it could have an effect in that manner. But we're talking about, this is a going concern, not selling the club.
One more question. Did Ray say that depreciation cannot be funded from operating, must come from capital investments?
I said that only 10% of the clubs, the 1,000+ clubs we've analyzed, generate the money to cover depreciation from the operating ledger. 90% of the clubs in the country set the operating ledger to break even, excluding depreciation. So the point was that to overcome the depreciation expense, we have to rely on capital income. I showed the operating result chart in clubs by that data very clearly. Clubs are hovering, that data shows it without a depreciation on the operating ledger. 70% of clubs are hovering around break even operationally, excluding depreciation. So yes, to make the point clear, it's not the operating ledger that's going to generate capital. The way you generate capital to reinvest in the club is through capital income, not from the operating ledger. And here's the point. Here's another view of it. So there is a hierarchy of capital income. We think of it in terms of this. Initiation fee income is great because that's coming from members who believe they should join, become owners, if you will, by writing a check, which helps the current members. They've already theoretically contributed capital. Recurring capital dues, we believe it's a best practice that recurring capital dues are tied precisely to quantified future capital needs. I'll get into that in a minute. Some clubs do, back to the questioner's point, generate an operating surplus. The club on the right here shows a club where they get 78% of their capital from initiation fees and 22% from operating surplus. I would suggest they do that year in and year out consistently. I would suggest that's really an intermingling of the operating and capital ledgers. It's okay. I'm not saying don't do it, but the reality is when people think they're paying X dollars a month in operating dues, some portion of that's actually targeted for capital if you're budgeting significant operating surpluses like that. The club on the left is the club on the right is a relevant club. They're very healthy. They get great amenities and services, and they've invested like heck in the last 10 years. They're very relevant. They have an $80,000 initiation fee, and they got a waiting list. One of the few clubs that does. The club on the left is not as relevant, has had flat net worth over time, and can't generate enough capital from its initiation fees, so it leans on recurring capital dues as the orange pie slice. It's leaning on recurring capital dues wisely, in our opinion, to fund the gap that exists from initiation fees only. Some clubs have donations of contributions from members in terms of capital. Some clubs have capital assessments. I'm going to get into that in detail. We think that's low on the hierarchy of capital income. I only use capital income here, not debt. Eventually, debt's got to be paid off in one of these manners. And then, of course, it could sell assets to realize capital income, but that's not a. We think over time you really want to accumulate assets, not sell them. So we know why we need capital. We have to invest in property, plant, and equipment. We believe, and I think the data to this point shows, that clubs invest reactively rather than proactively. And I think it's as a result of overemphasis on the operating ledger in lieu of the capital ledger. In other words, we're so busy scrutinizing last month's operating results versus budget, we don't have enough time to plan forward for capital. Capital is invested in two manners: repair and replacement of existing assets. We are coining a new term, obligatory capital, which reflects what it really is. The members who were at the club when those assets were consumed are obliged, they're on the hook for making sure they've contributed their fair share of the capital they've consumed. The other type of capital is, and someone had referenced this earlier, aspirational capital. When a club expands or adds to its asset base, it needs to generate money to put something in place that hasn't existed yet. So those are the two types of capital, obligatory and aspirational. Just real quick, I want to delve into a concept which is so critical as we tie the bow on this whole thing now. And that's a capital reserve study. Every club in the country should have a capital reserve study that's up to date and done professionally. We don't think this is do-it-yourself stuff. Some do. Frankly, respectfully, I completely disagree. But the capital reserve study is the quantification in today's dollars of the replacement of the physical assets that will eventually be depreciated. It's a 20-year view at least, and it shows year by year by year which assets need to be replaced based on a physical assessment of their condition, how much it will cost to replace them. And every asset has a view like this. There's a concept called fully funded reserve. If you take an HVAC unit that was installed in 2000 at a cost of $12,000, that to replace today costs $20,000 because of inflation. If the assessment says that it needs to be replaced in 2 years, that means it's going to have a 20-year useful life, and at the end of 2018, 18/20ths of its useful life was consumed. If the club had set aside cash equal to the consumption of that asset, 18/20ths of it, it would have $18,000 in the bank. And in the next 2 years, it would generate another $2,000 so that when it needed to be replaced, it wrote a check. The HOA, or POA, Homeowners Association, Property Owners Association industry, has looked at this for years and years and years, 50 plus years. It's a science. We don't need to reinvent the wheel. I'm not going to say clubs are identical to HOAs or POAs. That's not the point of the webinar. I could have an hour discussion with anyone that wants in terms of this concept, but it's a rough idea that makes a heck of a lot of sense. There's 3 thresholds they talk about. When you look at the amount of capital reserves that have been generated in relation to the fully funded reserve amount. So the fully funded reserve amount is, take the equation I just showed on that HVAC unit and do it for every single asset in the club. So take the percentage of useful life consumed times today's current replacement cost of the asset for every asset in the club and add it up. That's your fully funded reserve number. The HOA world says there's 3 thresholds that they designate as indicative. The first one is if your reserves to fully funded ratio is 30% or less, it's inadequate. If it's 30 to 70%, it goes from inadequate to at 70% adequate. And then if it's 100%, that means you have reserves equal to your fully funded amount. You're fully funded. That ratio is 100%. We've begun to investigate this ratio for clubs. And on the right side of this slide, you see the reserves to fully funded ratio for about 11 or 12 clubs. And you can see that the numbers are real low in relation to the 30% minimal threshold that's exhibited through the science in HOAs and POAs. There's a real club, I don't name it, but let's call it XYZ Club, I was at recently. They had a current replacement cost. If you replaced all their assets in today's dollars, it was $20 million. If you took the consumed life as a percentage of each asset and times it by the 20 million, you have 6 million. Their fully funded reserve number is 6 million. They have no capital reserves, therefore they were 0% to fully funded. Here's the issue, and this is what ties to debt and assessments. You know, I know you're on the webinar for this reason, but I will say we're getting to the punchline. The issue is what I call a fairness issue. Now, I'm not standing here or sitting here advocating that clubs should have a cash balance equal to the fully funded reserve amount, but I am going to advocate that clubs should know what the fully funded reserve amount is and know what their ratio is. And if we don't, we're not discharging our fiduciary duty. At my club, we had an irrigation system that's 50 plus years old, and we didn't have the money to replace it, and it needs to be replaced. We do now. But the issue is that over a 50-year period, we hadn't matched capital income to the consumption of the asset, so we didn't have the money. So all the members at the club that aren't members now that left the club somewhere in that 50-year period, but were members of the club for 20, 30, 40 of the 50-year period, they actually left an obligation to future members. So when I get asked the question, why should we generate capital reserves in a club and have a bunch of cash on the balance sheet? The answer is because that's fair. It means that the members who contributed, who consumed the capital have contributed an equal amount to their consumption, in cash. And if they don't and they leave the club, and what happens when you have an assessment, people leave. If they leave the club, then they're leaving an obligation for someone else. It's a fairness issue, not a financial issue. We can actually measure now with this concept, this logic, the fully funded gap per full member equivalent. And what you see for those same 11 or 12 clubs on the right is the fully funded gap per full member equivalent. The thing that astounds me is that the number, look at it, somewhere around 10, 15 grand. A couple of clubs, it's much higher. Those clubs are in trouble because they've got dilapidated physical assets. But it's a 10 or 15 grand number. Now, I know that's not a small number, and I'm not saying we should all write a check for 10 or 15 grand to a club right now, but in the context of time, it's not a large number. I'll often say to clubs, like the last club I was at, the gap was 10.7 per FME. If I could turn the clock back and I was here 10 years ago, that's 120 months. If we wanted to develop the money and the capital and commensurate with the consumption of the assets, then each member basically had to pay $80 more a month. That's not crazy stuff. It's actually very rational stuff. It's very reasonable thought. And maybe it wouldn't have been 80. Maybe it would have only been 40 a month. But then the club wouldn't have had a 0% ratio. It would have had a 50 or 60% ratio, and it wouldn't have capital assets that have a 36 net to gross PP&E ratio. It would have a 60% net to gross PP&E ratio. It would be more up to date, more relevant, and more fresh, and there'd be more prospective member demand. So this is the key. Now, what happens in clubs is because we don't do the planning that I just elicited, we actually replace capital assets reactively, and we tend to use two approaches. One is capital assessments. A capital assessment, I really believe, is the manifestation of poor capital planning. And what happens when clubs have assessments? We know members leave who don't want to cough it up. But the members who are leaving because they don't want to cough up the capital assessment have consumed capital that they haven't necessarily made up for. So they're leaving that obligatory need to a future member. If there were recurring capital dues in that period of time, they would have been paying right along with their consumption, and everyone would have paid their fair share while they were a member. So I really believe we're going to try like heck to get the industry to start looking forward, planning forward on capital, and matching the capital income with the capital consumption so that everyone's paying their fair share and so that clubs don't get themselves in a jam in terms of not having an adequate amount of capital, which is exactly where we are, as demonstrated by the slide that showed 70% of the clubs in the country are not generating the capital necessary to replace themselves. That's one view. Debt is another view. Now, debt is also, if we're using debt to repair and replace assets that existed, that is absolutely a result of poor capital planning. We're using debt to repair and replace assets that were consumed by members who haven't coughed up their fair share. And the debt has to be repaid, and it has to be repaid via capital income. The only difference is it's being repaid in the future by members in the future as opposed to the members who consumed the capital in the past. And the double twist on it is there's a tax on that poor planning, and the tax is interest on the debt, and the future members are paying that tax as well for the past members not coughing up the adequate capital. I could see how debt, and someone asked how much aspirational capital is acceptable. I can see debt as an acceptable approach to aspirational capital because theoretically that investment will drive member demand. Member demand will drive capital income from incoming members, and that's essentially a return on that investment. So we're okay with that. That makes perfect sense. How much? There's metrics we use, debt to equity ratio, which I showed you, debt to revenue ratio. We believe that the debt to revenue ratio should not be over 100% ever. The average club's debt to equity ratio is 20%. I don't think it has to be that low. It could be higher. But the key to it is that whatever debt you have to make sure that you have a capital income stream in the future that'll allow you to cover that debt and make sure that you have the coverage on the principal and interest that is necessary to maintain the covenants that the bank will put on the club. So we're okay with, and I'm frankly okay with that, even if it was used to do repair and replacement of assets that were consumed in the past, as long as we all realize it and we know what we're doing, because there might not be an alternative. So I'm not critiquing it in that regard, but we are trying to get everyone to lift their vision from last month's income statement and results against budget to the next 10 years capital needs and capital resources, because that's the way clubs will become healthy financially. The best practice approach is forward-looking capital planning. This is a theme for finance across the industry. Precisely quantifying the future obligatory capital needs, a capital reserve study is required. Our estimate is only 15% of clubs in the country have one. That's why 70% of the clubs in the country have not generated adequate capital. By the way, back to the net to gross PP&E ratio, I neglected to mention it. The median's 48, but we believe that ideally that ratio is in the mid-50s. Only 25% of the clubs have a ratio in the mid-50s. 75% don't. That ties almost exactly to the 70% not generating enough capital. It all goes hand in hand. It goes to the net worth, that half the clubs are worth less today on paper. These three concepts, they are all exactly tied together. We've done the research to figure this out. It's a critical point. By the way, this is all new information. We're not, and having done a lot of service to my own club's board, I'm not sitting here critiquing what's happened in the past. I really, frankly, don't care what happened in the past. What we're trying to do is look forward and take the new information, the new tools that we have developed and we have discovered, and use them to plan a better future for our clubs so that things are happening proactively, and the club is literally building a foundation of future sustainable financial success. So the capital reserve study is the foundation. Obviously, as one of the questioners asked, we also have to quantify future aspirational capital needs to expand or add to the asset base, which is tied to a strategic plan. Then we look to see if there's what the future capital resources are as things sit in the moment, from initiation fees, from recurring capital dues, and other. And what we're trying to do is we're trying to determine gaps that are existing between the capital resources and needs, but we're trying to identify them ahead of time. That's the key. Because if we can identify them ahead of time, we can plan to get the income to be ready, and we won't be in the moment when all of a sudden we have to do it, taking on debt to pay for something in the past, or offering an assessment to pay for something that occurred in the past. So that forward-looking view, that forward-looking planning, that identification of the gap between capital resources and needs done in a proactive manner, that's the secret to financial health in clubs, not scrutinizing the break-even operating ledger every month. And we at Club Benchmarking are big believers that recurring capital dues, which makes it fair for everyone, we pay for capital as we consume capital. We really believe that that is a best practice method to filling the gaps that we see in the future if we're doing the right capital planning. So at that, I'll do some conclusions, and maybe there's some questions. I hope there are. But the strategic approach to finance in a club is thinking forward, not backward. Understanding how net worth over time reflects itself in capital income and capital planning practices. So the half of the clubs that are worth less today on paper than 2006 haven't done a proper ledger for capital planning by definition. Otherwise, they would be worth more. Understanding how net worth over time is a result of capital income, not the operating ledger, and how that ties to the status of property, plant, and equipment. We put forth some quick ratios. Every club can do this in 5 minutes. It says hotel. I did a webinar yesterday for HFTP as well. But the quick ratios are your net worth over time metrics, your net to gross PP&E ratio, your operating result as a percentage of your operating revenue. We can do all of that for you for free. We do it for free as a service to the industry. If you want, send us an email. We'll get your net worth and balance sheet benchmark back, and you can see it against the other 600 clubs. But ultimately, we have to embrace the concept that capital income is the financial driver. That's the key concept. Once we've embraced that concept, things will get much easier financially in clubs. And with that, Terry, if there's any questions or comments, I'm happy to take a crack at it.
We do have questions, and in the follow-up email, I'll also send a link that'll connect you with the project manager that does those reports for you, if you'd like to have that done. So this question is, for the capital-starved clubs, what's the best way to communicate to the membership about the club's capital needs?
I think that the first step, if you haven't done it, is to get the person on our end to help get your net worth over time and balance sheet benchmark. I've found that data, and everyone in the club understands. You don't have to understand finance. You don't have to understand finance. You don't have to be a business person to understand that net worth must go up over time. So we've found that the net worth and balance sheet benchmark resonates widely, and that's the beginning of the discussion. Once you can see the way it's been to date, then you can change the future. And I really can't overemphasize for capital-starved clubs how that data becomes a turning point and how it can actually feed the mentality that members have to act like owners. And the only way we can get the net worth to turn around is by contributing capital income. And once we do that, we can invest it and we get the ball rolling in the right direction.
Okay, next question. What is the general range of cost for a capital reserve study?
The range is somewhere between 10 and 30. I would say the average 18-hole country club is about 20.
And that's another service that we do if you'd like to get a no obligation proposal, just to get a look at the scope and the scale of it. We do that as well, and I'll include that link in the email. What do you suggest for a club with zero capital reserve and substantial replacement needs, that also wants to add amenities?
That's I think it goes back to, if you have zero reserves and substantial replacement needs, then I think that the previous questioner's term, which we use, I think that would probably define a capital-starved club as well. And I think that the course of action is the same. I think that the starting point is to understand where you've been in the last 10 years as a precursor to determining where you need to go in the next 10. And in the end, capital-starved clubs, they're all, and obviously that's not a homogeneous bucket. So we saw 70% of the clubs haven't generated adequate capital, but there's shades of gray there, in that some of them are close to what they need, some of them are not close. So it depends where you fall on that spectrum. When we talk about capital-starved clubs, we're talking about the quarter of the industry that has the lowest capital income. And if you're in one of those clubs, this is passion pouring out of me. The data changes the dialogue. It does. Because without that data, some people won't even believe that there's capital starvation occurring. I've noticed as I make my travels, it's hard for some people to notice how their club looks because they don't see other clubs, so you kind of get used to it. But I think the data changes the dialogue, and it's critical to sparking the engine to go in the right direction. But I will say, at some point in the not too distant future, once you have the data, the way to get the engine cranked, to get it back turned on, is going to come from members' contribution of equity. It can start small, but it's got to start somewhere.
Okay, I think I'm not seeing any more questions at the moment, so I think that's it for today.
Well, thank you, everyone, and I hope we hit record.
We did.
Excellent. Well, thank you. Thanks, everyone, and have a great day.